Mr. Bear Finance with you here today with another quick lesson on buying, leasing, and financing. What option works for you? The short answer is, it depends on your cash flow, needs, and preferences. Buying, leasing, and financing a car all have unique tax benefits, but over time, these tax benefits will all even out. Let's simplify our analysis here by excluding the impact of taxes. Let's get to it. Let's start with the buy option. Straight up the simplest option. Pay cash up front and don't worry about anything else. That is, as long as you have enough cash up front. So let's go to the pros now. You own the vehicle, enough said, which allows you to sell the vehicle and get back some cash at any time. How much cash you get depends on how good of a salesperson you are and how well you know the second-hand vehicle market. Next is no mileage restrictions. Drive as much as you want. And lastly, you don't have to worry about pesky interest costs because there are none. Now to the cons. Firstly, you're stuck with the same vehicle until you sell it. Secondly, you need to have a large sum of cash ready to go. And lastly, if you bought a dud, which breaks down a lot, you're stuck with it. So what type of person should go with the buy option? People with cash on hand, who can deal with the cash up front, prefer to own a car, are familiar with the second-hand resale car market, and drive a lot and can't be limited by mileage restrictions that come with leases. Next up is lease. This option requires the least amount of cash up front, but usually results in the most cash paid out the door over time. But there are benefits, of course, you get in return for this, which brings us to the pros. Firstly, as I said before, this option requires the least amount of cash up front, and you get to drive a new shiny car every few years when your lease term ends. You aren't committed to one car, and if you get bored of one, you can look forward to the change. Since repair costs tend to increase when a car gets older, the lease option also tends to have the lower maintenance costs since you are driving a new car more often. As for the cons, the flexibility of switching cars every lease period comes with increased costs. Over time, you are usually paying more overall for this benefit. The other main downside of leases are that they often limit how much you can drive during the lease period before penalizing you again, with, you guessed it, even more costs. So who are leases suitable for? They are suitable for people who get bored easily, people who like trying something new every once in a while, people who don't have a lot of cash on hand, people who don't enjoy the hassle of bringing a car to a mechanic more frequently, and also for people who don't drive very far or very much each year. In summary, leases provide a lot of benefits and flexibility, but all of this comes with increased cost over time, and at the end of the day, you are usually paying more cash out the door. Lastly, we have financing, often the middle of the road option. The benefits are the same as buying a car outright in that you own the car, you can resell it at any time, and are not limited by how much you want to drive. What makes it different than buying a car outright is that it requires much less cash up front, which is instead spread over the financing term. In exchange for this flexibility, you pay them additional interest costs. Essentially, the car company is loaning you money to buy the car for a fixed rate, similar to a short-term loan from a bank or a line of credit. Financing is often preferred if you don't have the cash up front to buy the car, but still want to own the vehicle. How this compares to the other options depends on what the terms are. Over time, it can be the cheapest option if the interest rate of the finance term is less than the return you can get elsewhere. Else, it usually ends up being cheaper than a lease, but more expensive than purchasing outright. The best way of looking at this is through an example. To keep it simple, let's look at a simple example with very simple assumptions. The goal of this channel is not to deep dive into the confusing world of numbers, but rather to simplify the situation for someone who is not well versed in finance, numbers, or math. Keep in mind, if the assumptions change, the result also changes. Let's get started. So let's assume we are purchasing a $30,000 car, which roughly has $4,064 of taxes. For the buy option, the total would be the $30,000 car plus the $4,064 of taxes, which gives us a total of $34,064. The present value of this today is also $34,064. Simple enough. Now let's go to leases. So let's look at a lease option, and let's start with the assumptions. So we'll use a lease rate of 6%, at a term of 3 years or 36 months, a residual value of 40%, which is 40% of the $30,000 car that we're buying. So this would give us a $12,000 residual value. And based on those terms, we will get a monthly payment of $731.23 as detailed in column A. If we multiply this number by 12, we will get $8,772 as per column B, and this is your annual cash outflow out the door. And if we look at column C of $26,324, this is your total cash paid over the term, and this is basically your monthly payment, $731.23, times the lease term of 36 months. So once we adjust the present value of this amount of $26,324, we will get $24,398. But we also have to add back the residual value that we talked about, the 40% times the $30,000, so $12,000. But we also have to adjust this amount with the present value of money as well, and this will give us $10,366. So the total cash outflow over the term for the lease is adding column D and column E, so $24,398 plus $10,366 gives you a total cash outflow of $34,764. This would mean that your lease option is $700 more expensive than the buy option, but it gives you more flexibility in driving new cars more often. So lastly, let's look at the finance option. And again, we'll start with a few assumptions. So let's use a finance rate of 4%, the same discount rate of 5%, a term of 5 years or 60 months. This will give us a monthly payment of $629. If we multiply this number by 12, we will get $7,548 as detailed in column B. If we multiply $7,548 by 5 for the 5-year financing term, we'll get $37,740, which is the total amount that you'll be paying out the door for the finance option. So if we adjust this for the present value or the discount rate of 5%, we will get $33,331 as detailed in column D. The finance option has no residual value because you own the car, and there's no residual value of a car to purchase out. So your final total cash outflow adjusted for present value is $33,331. This represents the cheapest option as compared to the $34,064 as per the buy option and the $34,764 as per the lease option. So at the end of the day, what's the right answer of buying, leasing, or financing a car? It depends on your needs, preferences, and cash flow. Exactly the same as what we said in the beginning. Everyone's situation and preferences are different, so there is no one right answer. Some other considerations to think about when you're purchasing a car is the lease option really depends on the type of car you're buying and the residual value at the end of the lease. Some cars retain much more value than others. For example, if you have an advantageous leasing rate, a high residual value, and you underdrive the car and you buy it out, it could become the cheapest option. Vehicle loans from a bank can often provide better terms and rates than financing from an auto dealership. So this is also probably worth looking into. That's it for now. Mr. Bear is logging off today. Thanks for watching, and I hope this helps in your decision making.